Now it's time to welcome our first guest, Dr. Wade Pfau, Professor of Retirement Income. He's also the co-director of the New York Life Center for Retirement Income and author of the new book, Safety First Retirement Planning, an integrated approach for a worry-free retirement. Dr. Pfau, thanks so much for joining us today right here on The Income Generation.
Well, thank you for having me. It's a pleasure.
So, okay, tell us about your book. Why did you feel like at this particular time, this book needed to be written, that people needed to read about what you had to say?
Great question. So as I've researched retirement income, and my job is professor of retirement income, so I feel like it's my duty to look at all the approaches. And I really came to see how there are these two different approaches. There's this investments only model that tries to look at how do you spend from a total investment portfolio. But then there's this more integrated strategy that looks how different tools working together can really lay the foundation for better retirement outcomes. And I think that a lot of people just didn't have the understanding about this more integrated type of approach. And so that's what I set out to look at. How do you build strategies around using investments and insurance? And to just explain how that whole process can work, because it really can lead to better retirement outcomes than trying to rely on the stock market to give you these outsized returns as a way to fund spending.
Well, especially, Wade, because, you know, the old rule was that 4% cash flow rule, which was never really a rule, but it was maybe a myth perpetuated by Wall Street. But nonetheless, people thought if I got $1 million, I could take $40,000 a year, and chances are I won't run out of money, statistically speaking. But as you know, since the turn of the century, the stock market didn't do so great, at least for the first 13 years of the century. And interest rates are lower now. So now the newer rate is down to 2.7%. So essentially, doesn't that mean that someone who has $1 million using the former method, not the method you're espousing, the former method, that they can only take $27,000 a year with a reasonable chance of safety off of $1 million portfolio? Am I missing something?
Yeah, well, that's the idea, and it's because of the inefficiencies that the issue is people have to be worried. They might live a long time, and the markets might not cooperate. That method requires an aggressive asset allocation, a stock allocation of at least 50%. And so the only way you have to manage those risks is you spend less to make sure you don't run out, even in a bad market environment and even with a very long retirement. And so that's why it can imply a really low return on your investments if you have to lower your spending to that level. But that's really all you can do when you're trying to fund a fixed spending goal from a volatile investment portfolio.
And the reality of it is, this is all backed up by the mathematics you're familiar with called Monte Carlo analysis. And the 2.7, for example, in the particular study that I'm thinking of, still had a 10% chance, albeit small superficially, but 10% chance of running out of money. And like I like to say, imagine you and I got on an airplane, right? You're a pretty conservative guy, I would guess. So we get on an airplane together, and the pilot comes on and says, hey, we shouldn't have any turbulence. It should be a smooth flight to LA today across the country. There's only a 10% chance we're going to run out of fuel before we get to our destination. So buckle up and enjoy the flight. I have a feeling you and I are going to be like Archie Bunker and Meathead, pushing each other out of the way, trying to race to the exit to get off that airplane. Are we not?
Right, because it's a catastrophic outcome in that 10% of the time that it doesn't work.
That's right. And that's the thing sometimes that people, I think, fail to think about. It's not just the probability, but it's the magnitude of the negative event that could occur should that outcome happen. And that's why you might get people who have older cars that have taken the collision insurance off their automobile because, all right, if it's $7,000 and I total it, well, I lose $7,000. But most of those same people wouldn't even dream about having a home without fire insurance on it, because the magnitude of that loss is much greater, even though the probability of your house burning down versus getting into a car accident is much less. Am I on the right path there?
Right. That running out of money in retirement can leave one destitute, and to the extent you don't have other resources, of course you have things like Social Security, but beyond that, if you're looking at a really reduced standard of living, yeah, you have to account for. You can't take a very high probability of something like that happening.
Yeah, no, of course. And even 10% is a low probability, but it's a lot higher than zero. So we need to take a quick commercial break. We come back, I'd like you to share with our Income Generation members this integrated method, as you like to call it. I think it's very similar to probably what I refer to as the income method. But we're looking forward to having you back in just a minute, so please stick around. And you stay with us too. We'll be back here with much more in terms of words of wisdom from Dr. Pfau in just a moment. And now it's time to welcome back Dr. Wade Pfau, Professor of Retirement Income and author of the new book, Safety First Retirement Planning, an integrated approach for a worry-free retirement. Wade, thanks so much for sticking around.
Yeah, my pleasure.
So we agree on one thing, that the withdrawal method, the traditional method of retirement planning is, as they would say down here in Southern Florida, no bueno. It's not what we want to do. So tell our income generation members about the integrated method and what you mean by that.
Well, the integrated method, it's a lot more like how traditional pensions work. Rather than kind of just trying to fund a fixed spending goal from a fluctuating investment portfolio, you match assets to your expenses. So you can do that with individual bonds, for example, where you have bonds maturing and funding the expenses for that year of retirement. You can use tools like an annuity, which give you that fixed payment that you're expecting, so you have your spending covered and you know what that spending is going to be. And that can be further linked to, well, the longer you live, the more expensive your retirement becomes, but you have that continuing payment for as long as you may live. And by funding your spending, the baseline spending in retirement that way, that frees up other parts of the investment portfolio to provide flexibility and to provide resources for the unexpected. And working all together, that's what can lead to better outcomes in terms of supporting the spending goal and providing other resources, either for liquidity needs or for legacy at the end if you end up not needing to use that.
So you mentioned annuities, you mentioned bonds, bond-like instruments to generate a consistent income, but you also implied what's known in the insurance world, and as I know you're aware, of liability matching. Matching the maturities of your liabilities with the maturities of your assets. And that's what insurance companies do. If insurance companies, for life insurance, for example, have a pool of people they think are going to live 30 years, well, then they'll match that liability with a 30-year bond portfolio. So that hopefully right about the time those assets are coming due on a guaranteed basis, they can then fund that liability. So some of it sounds like it's generating interest and dividends and income, but the other part of it also is that liability matching concept, correct?
Yeah, that's what it's all about. It's about trying to make personal finance more like what a pension fund does, because people have to understand that with interest rates being low, if interest rates go up, you have losses on your bonds. And what pension funds are able to do is they know what their expenses are going to be, so they can match, if interest rates go up, the asset value might go down, but they have that match to their expenses will go down as well, and those can move together in tandem. And that's what asset liability matching is all about. And it removes that risk of rising interest rates leading to losses on your investments.
And it's interesting because even in today's day and age, you can earn more that way through investing for interest and dividends and be able to withdraw more than the 2.7% using the withdrawal method. Even in today's low interest rate environment, as a general rule, you can do better with more peace of mind, can you not?
Well, right. If you're not worried about depleting your assets and you're putting together a portfolio that is providing the income you need without the principal, you could potentially spend more. The reason that 2.7% number, it's so low just because, as I was saying, really the only way to manage the risk there of market downturns and a long life is you have to spend less to protect the asset base, because that strategy has you spending down principal. So if you can set up the portfolio that you're not automatically spending down principal because there's a market downturn.
I don't know about you, Wade, but most people I talk to, they don't retire so they could spend less. That's not what they want. They want to be able to enjoy retirement with a clear conscience. So we need to take a quick commercial break once again. Again, please stay with us, Wade. And you stay with us too. We'll be right back here with more in just a minute on the income generation. I'm David Scranton, and we'll be right back. Now it's time to welcome back Dr. Wade Pfau, Professor of Retirement Income and author of the new book, Safety First Retirement Planning, an integrated approach for a worry-free retirement. Thanks for sticking around once again.
Thank you.
So I guess it's as simple as this, right? We all know insurance companies know how to make money, and pension plans, good, solid run pension plans, know how to make money. So I guess if investing for income, interest and dividends, and if liability matching is good enough for them, it should be good enough for us, correct?
Right. And they can do that. They're able to pool this risk. And so being able to benefit from those aspects can really help our financial planning as well.
So why do you think it is then that so many advisors out there don't understand this? They think the withdrawal method's the way to go, that just stay in the market, stay aggressive, control your risk through reducing your withdrawals. Why is that? I mean, I've got my theories, but I'd like to hear yours.
Yeah, I think a lot of it goes back to, in the investing world, we're so used to hearing examples like, well, if you assume an 8% rate of return, this happens, or if you assume a 12% rate of return sometimes, this happens. And of course, if you could consistently get those types of returns, yeah, I mean, go for it. That would work fine. But the reality is, and especially in retirement, when people are looking to take less risk, and when they're taking distributions from their assets, it actually causes investment volatility to have a bigger impact, that you can't assume those types of rates of return. And when you start looking at more realistic style returns of what you need to do to have a high chance of not running out of money, that whole aggressive investment asset allocation type of approach starts to fall apart. And that's what leads to such low spending numbers as being feasible.
And I know you're not a professor of psychology, but I believe it's because in the 1990s, you could get away with that. You could get away with investing aggressively in the market, take a higher withdrawal rate, and everything was fine. But it doesn't mean it's a sound strategy. It means that you were just plain lucky. But unfortunately, sometimes it's our earliest experiences in life that shape our paradigms. So I think right now, you and I are looking at a generation, I look at a generation of investors. You're helping teach and educate a generation of advisors that maybe their earliest experiences are misguided. Maybe it gave them wrong information. So with that in mind, what are the best words of wisdom that you can give for our income generation members as to how to live a comfortable, rewarding retirement with peace of mind, and how to avoid some of these pitfalls?
Well, yeah, you want to be able to rest easily at night and not have the stress. And so if you're somebody who does worry about the stock market, there are other approaches, and the investing world would tell you, well, don't do anything that's less aggressive because you give up this opportunity for outsized stock market returns. But by setting up that kind of income-based portfolio, or by using annuities that add this additional spending power that investments can't make available, and it's this idea of risk pooling and having people who live longer receiving this extra spending from the risk pool, that can allow for a more comfortable retirement, not have to worry about outliving assets, and therefore be able to better enjoy their retirement without that sort of worry.
Annuities are such a controversial thing. We only have 20 seconds left. What do our viewers need to know about the cliff notes of annuities?
There's many different types of annuities, and sometimes they get used for different purposes like tax deferral and so forth. But if you're looking at supporting a retirement spending goal, it's really tough to beat something that provides that protected lifetime income, whether it's a simple income annuity or whether it's one of the guaranteed living withdrawal benefits on a deferred annuity. That's a more efficient way to get this power of risk pooling to support a retirement spending goal with less assets.
Yeah, to put it simply, it's really the only tool that does actually literally guarantee and ensure a lifetime income stream. So Dr. Pfau, thanks so much for being part of the show. Hope to have you back.
Thank you. It's been a pleasure.
And you stay with us too. We'll be right back here with more coming up in a minute, right here on The Income Generation. I'm David Scranton, and we'll be right back.